in terms of export or import. Today it is possible that the company is incorporated in India, the goods are in Singapore, the customer is in Australia, the smart server which processes the order is hosted in Hong Kong, and the internet service provider is in Dubai, and this company is listed in New York Stock Exchange or in other jurisdictions as well, involving a dozen of the nations which have to synchronize in terms of reporting requirements. And it is possible that the shareholders, the stakeholders are spread across the globe. And therefore, when you talk about the financial results of a business, you can speak only through the language of accounting. It is the accounting language that can communicate the financial results to the stakeholders in a befitting manner, in a transparent manner, and in a manner in which they will be in a position to take their decision, either to invest further or to liquidate, or to know as to what is happening in terms of the scarce human and other capital resources that are at the disposal of the management of the company. So it is in that context, the business language, which is accounting, needs to be harmonized, made uniform amongst the various geographical locations, jurisdictions and economies. Because we know that geographical barriers have vanished. 20 years ago, when one of my friends toured Europe and came back, I asked him as to how do you find the cultural fabric of this continent? To which he replied that in England, everything seems to be permitted except those that are prohibited. In Germany, everything seems to be prohibited except those that are permitted. In Russia, as it then existed, everything seems to be prohibited, including those that are permitted. And in Italy, everything seems to be permitted, including those that are prohibited, which means that you can do anything and get away with. Of course, I am not trying to say anything about India, though Italy and India start with the first alphabet, same alphabet, and as some other nexus as well. But as far as the IFRS is concerned, in terms of the flow of investments, the acquisitions that are happening, it is no longer one-way traffic as far as flow of funds are concerned. It's not only inbound investments, it's also outbound investments, where Indian corporates are acquiring businesses, establishing subsidiaries, holding joint venture operations, so on and so forth. So in the light of that, maybe the best practices available across the globe in this language, that is accounting language, needs to be codified. And standard is nothing but codifying the best practices. In fact, standard operates as the grammar for speaking this accounting language. And it is in that context, an endeavor is being made to converge with IFRS so that we can also speak with the same grammar, the language of accounting. And when this process is evolving, there are challenges, because India, to bring about such a change is not easy. It's very difficult because all the corporates, if you take only the corporates also, forget about the non-corporates, they are not under the jurisdiction of the same regulatory body or the ministry. You have a host of regulatory authorities who govern different segment of corporates. And therefore, it is in that sense, the IFRS implementation is bound to take or pose challenges. And as professionals in this domain expertise, we need to comprehend the challenges and be prepared or equipped to face them. In terms of the classification of standards, as we all know, we have recognition standards, we have measurement standards, we have disclosure standards. And as far as disclosure standards are concerned, there may not be that much of a challenge. But when it comes to recognition and measurement standards, there will be allied aspects that need to be comprehended. So in that context, how are we going to equip ourselves and also advise our clients in terms of the implications or ramifications or the change in terms of the financial results that will appear in the financial statements, because it is possible that on implementation of IFRS, in some cases the net worth could be eroded, in some cases the distributable surplus could get enhanced, because primarily IFRS is fair value driven, whereas all along we have been following historical cost. And in terms of revenue recognition, again, there are going to be differential treatments. So in terms of recognizing the revenue, in terms of provisioning for liabilities, and in terms of accounting for leasing, and also with reference to the taxation issues, because that's going to be the major challenge, where ICI and CBDT, I'm given to understand, are working out on the solution on convergence with IFRS, even in the context of MAT applicability, on which book profit you are going to levy tax, and how is that going to be synchronized with the existing tax laws, which have not recognized the Ind AS or IFRS as on date, and DTC also there is no mention at all about that. So in that context, there is a real challenge. And what European Union did when they converged with IFRS in 2005, they allowed the taxpayers to compute the income in accordance with the national accounting standards, disregarding the IFRS. In other words, IFRS was used only for the purpose of preparation of financial statements and for presenting it to the stakeholders, except taxation in the initial period. So the same analogy can also be looked at as far as the Indian scenario is concerned. That is one possible solution. Another possible solution is in terms of reconciliation. An additional statement may be required, because even today you have the depreciation as per taxation being different as compared to the company law, and 145A providing for valuation of inventory in a different context as compared to what is propounded by the accounting standard, so on and so forth. There are areas of distinction between taxation and accounting treatment. So therefore, on the same basis, maybe some kind of a reconciliation has to come, but that clarity has to come at the earliest possible situation. So in that context, I would feel that we need to comprehend, gear up for the challenge. Unfortunately, the major group of companies, substantial number of assessees, taxpayers, or the business enterprises would get covered by IFRS implementation only towards 2013 and 14, so to say. So in the initial 2 years, maybe whatever experience we comprehend, we should be in a position to replicate to smaller enterprises as the process of convergence takes off. Even in the context of Ind AS 41, that is the first time adoption of IFRS, which is at par with the IFRS 1. ICI recommended that maybe the book value could be straightaway adopted as deemed cost. But NACA seems to have made a modification to this proposal, saying we will allow 1/4/2007, a cutoff date, and from there maybe you can work it out for the purpose of getting at the current value and accordingly deem it as the cost. So these issues need to be sorted out as to how the property, plant and equipment will be reflected after the IFRS related standards are applicable. Even the component approach, and again revaluing the assets, and the other comprehensive income statement capturing the unrealized gains, how they will be dealt with. So these are all the matters where there need to be clarifications, and I'm sure they will come before the need for implementation arises. Having said so much on IFRS, ladies and gentlemen, I was referring to US converging in 2014 to 16 and Japan converging in 2016. I strongly believe that looking at this scenario where many jurisdictions are going to converge after the convergence process in India gets accomplished, gets over, I see a lot of BPO, KPO opportunities within India for the accounting professionals to facilitate convergence in those jurisdictions in terms of outsourcing. So the expertise of Indian chartered accountant, as we get trained and groomed in the Indian context, will be greatly in demand, will be sought after in the neighboring jurisdictions and also the far west and as well as far east. So therefore, maybe that is yet another professional opportunity which we can look at. And being post-lunch session, before I migrate to the GST, having spoken about US and Japan, I need to tell you the anecdote that lingers or crops up in my mind. It was during Bill Clinton's period that there was an official visit scheduled to Japan. And when Bill Clinton's date of arrival was known, the Japanese Prime Minister wanted to gear up to provide an excellent hospitality, but he did not know English. So a special coach was arranged for him to be taught on spoken English so that at least few words of courtesy will extend on arrival of the US President, and thereafter the translator will take over. And therefore the few alphabets and few words and the formulation of few sentences, all that was done on a fast track mode. And the Japanese Prime Minister appeared to be quite comfortable till such time the D-Day came. And that day morning, he said, I'm totally confused. So find a shortcut method. So he was taught. All that you need to do is shake hands with the president, US president, and just greet him by saying, how are you? All that the US president is expected to or bound to say is, I am fine, how about you? And you simply say, me too, and then the translator will take over. And as the plane landed, the US President Bill Clinton was deplaning. Again, butterflies started flying in the stomach of the Japanese Prime Minister, but still he extended the arm, little shaken up. And the US President, with a smile, took hold of the hand and smiled at him. Then